Hello everyone, this is Ankur, the trainer for today. So I would just like to request all the participants so far if they can just quickly confirm by way of posting a question, if they can hear me clearly and they can see the this screen absolutely clearly, so that we can start with this webinar shortly. So already standing at 8:05, so we would be would like to start ASAP. So we already have a lot of confirmations pouring in from Sunny, Asmin, Tanay, Ankit, Karan, Rishikesh, a couple more, Kritika as well, Nitish. So it's absolutely great to have you guys. Welcome on board. This is going to be like a maybe 2 hours plus minus 15 minutes of session, wherein we would like to take you through a lot of insights as far as the the level 1 for December attempt is concerned. So I hope just like a basic hygiene check, you guys have received your admit cards from the CFA Institute. Please take these things very seriously. The name on the the pass ticket has to be absolutely same as that in your passport, because CFA Institute is very, very particular about all these things. So you have to really, really be very, very cautious about all this aspect. So even if, let's say, a spelling mistake of a letter is there, then also it becomes a little bit of an issue. So you should raise an alarm, with time in your hand. So that's great. And so Benjamin also joins us, so that's great. So we're just waiting for 3 more minutes as we saw the message that the final webinar to start with at 8:50. So in today's webinar we are going to cover 4 important aspects: the financial reporting analysis, which takes about 20%, ethics, which is anyways the big daddy at all 3 levels, 15% for in level 1, and then you have your equity 10% and corporate finance, whose weight has been minorly tweaked to become 7. Earlier it used to be 8, but this is hardly anything. So I guess we are good to start. Maybe just wait for a couple more minutes. And I just would request you guys to have your calculators also with you, because not only we will be doing some quick concepts here, we would love to do some questions as well, because only then these boot camps becomes a little more successful. The idea is to have very, very exam oriented approach for the level 1, which is coming up in December. So so it's going to be like an action pack. So just take a register or a piece of paper along with the pen and a calculator, so that you guys can work along with me in this webinar. So it will be like a like I said, a 2-hour session roughly. So I think with that we are good to start with it, and maybe we will gradually pick it up speed, and as many people will join in. What in fact you should also do, which Rishikesh has done, is just give a you can just post some questions that are bothering you. Through that it will be helpful for everyone in the group, number 1. Number 2, that's a personal doubt, so you should not stop it from asking. So maybe if I feel that the doubt is very, very specific and doesn't warrant time here, then we have your details, and I can speak with you in person at a different level, at a different forum. So maybe we can do that. Rishikesh, you're also asking about how does CFA help you grow professionally in career development. My fear is that, I think in boot camps like these, it'll be a little difficult for us to devote time. The only thing that I can say is that, if you want to grow internationally in finance, other than audit, tax, and accounts, then, for the investments purpose, CFA is like the best degree in the world. So I will restrict myself, in boot camps like this. You really need to be a little more time effective, in that sense. So with that, I think, absolutely good to start with, the first slide that I have here. And with that, just a little bit of introduction about me. So formal welcome to everyone. My name is Ankur. I am based out of Delhi, and I'm a CFA trainer. Have trained about maybe more than 3,000 students over a period of 7 years. Yeah, I mean, looks to be a little good number to boast. I mean the 70 batches over a period of 7-8 years is like a good number to have. So just to tell you that you guys are in safe pair of hands. As a corporate experience, I've worked in Maruti Suzuki, the Indian arm of Japanese car maker Suzuki Motor, and have about 4 years of consulting experience with EY, Ernst & Young. So I joined academia way back in 2012 full time. Before that, I've been doing it part time, and after that, I've also been taking up a couple of valuation assignments every month. I mean, just to be on the side of being on the relevant side of the industry, rather than becoming just theoretical with these academic experiences. I've been pretty lucky to have all India ranks at all 3 stages of CA, and yeah, I mean, passed out of very good college, Ram College of Commerce in Delhi. So I will be the domain specialist for 4 subjects for you, which will take up about 52% out of your 100. So that's a bit about me. Tomorrow you guys will have your session with Amit Parekh. He's based out of Calcutta, and he has similar experience, and academically, he's a senior colleague. You have, he's also done his FRM, and he's a pass out from IIM Ahmedabad. So all those who are, wanting for a mathematical aptitude and quants, so he's the guy that you can look for. So so he will take up the session tomorrow, and together, I mean, me and Amit come from a financial startup Fin Study Club, and that's where these sessions have been kind of sourced from. So I think today's boot camp, as Kapila is asking, that she's planning to give June 2016. Will that be helpful? Kapila, for the sake of everyone, and Kapila, I think it will be beneficial, if you join, because in any case, it will give you a pointed effort as to where would you like to, place a little bit of, effort in terms of the preparation. It's like a huge course. There are 10 modules, so you got to be very, very pointed as far as the effort is concerned. So maybe, I leave it to you. Maybe, since you are in June, so there's really not a, you're not driven to a wall. But yeah, I mean, it's going to be pretty useful to you as well. I mean, that's what I believe. Yeah. So with that, I am pretty much on to the topic for the day, and so these are like the 4 topics that I said we will do. So from here, we will start with a little bit of overview of each module. So so the first thing that I would like you to know as to what can you expect out of this 2 hours of investment, because right now we are sitting on 14th of November. It's like about 20 days for your exam, so every minute has to be counted in that sense. So we have moved to the sixth slide, and I am talking about the expectations that the participants may have from a session like this. If you guys face any technical problem, then the IT help desk, whom to contact. So through your links and through your emails, there would be a IT help desk. So that's how. Okay, so I think the slides are not changing. I mean, that's the feedback which is coming up. So here, okay, let me just check. Let me just check as to why is that happening. Let me just check why is that happening. Okay, so the slide not changing, is that the problem with everyone, or this is the problem only with a couple of people? Okay. Let me see what is the matter. Don't worry. Okay, is it so? Can you all see now? Hang on for a minute. Can you all see the second slide now? Okay, just take it easy. Can you all see the second slide now? Okay, cool. So I think the problem is resolved, and so fine. So let's just quickly start with where we had left. So great that now I think it is all working fine. So welcome to the session. This is Ankur, as I mentioned. Today I'm going to talk about FRA, corporate finance, equity, and ethics. Tomorrow you would be dealing with the balance 6 topics taught by Amit Parekh, and he will be taking up the balance 50%. So it's going to be like a power-packed session today, with almost 52% coming out from your today's effort. So with that, I am good to start with the the expectations, and this is a slide that we were at the list of important topics in each module, and that's what we are going to talk about each subject wise. So there are about different readings, and I'm going to prioritize the readings for you. I mean, which out of, let's say, FRA has got about 10 readings, so I will prioritize as to what are the A category, B category, and C category, so on and so forth. Okay, we will also talk about the discussion on confusing and difficult topics in each module. So I have a list of some topics which I would like to discuss, maybe spending 10-15 minutes on each subject. That's not like a list of comprehensive this aspect, because here the idea really is going to be to just mention some of the aspects which students sometimes find a little bothering to note down. The most important aspect is going to be the hands-on practice of critical questions, which I have for you, and maybe over email I can share those with you as well. And towards the end, we're going to talk about the strategy for each module. So in a way, this is going to be like a good session. Again, like I said, packed with pretty excited audience. So I hope that you guys are good to go. And with that, let me just start by the corporate finance, and that's where the role of prioritization comes into picture. So as I see that we are sitting at 8:20, and effectively we have 2 hours, so and 4 modules to cover, so that gives me 30 minutes per module. So in 30 minutes, not only we have to look at the prioritization part of it, but you will also have to do some questions. So we better go in a very efficient manner. Maybe whenever you feel that I'm going a little fast, then please don't hesitate to stop me in between. Okay. Now, so in corporate finance, you would be aware that we have 7% as the course syllabus, and you're smart enough to calculate how many questions are expected out of that. There are 6 readings overall. So the way I have written is as a matter of priority itself. So the first 2 readings here, cost of capital and capital budgeting, from the questions point of view, they are the A category readings. Honestly speaking, not only from the exam point of view, but for your basic understanding of finance, these are very critical that a student understand these 2 aspects very clearly. As far as the third and the fourth is concerned, I would put them in B category. Okay, very simple and easy readings, and it's like a low-hanging fruit for a student. And maybe reading 5 and reading 6. Corporate governance is really one of the thankless readings, which have been put in. I shouldn't maybe use words like thankless, but yeah, I mean, at the end of the day, from a student standpoint, this has been seen, that maybe the questions that come up from here, 50% of them are pretty commonsensical, and the balance 50%, yeah, I mean, the number is not great. Maybe a couple of questions in the entire day, so one or two questions. So maybe it doesn't really warrant your time towards the last part of your revision cycle. Okay, so please focus upon reading number 1 and 2, which is capital budgeting and cost of capital. Okay, so now with that, I am good to go to my next slide, which talks about the equity investment. Equity investment for you is 10%. I hope that you guys are noting it also, somewhere, maybe through screenshots, or maybe, I'm sure that, the recording of this webinar is also going to be made available to you. So maybe at a later point in time, you can do that. But the best idea, right now is going to be to, keep marking some of the important points that we are doing. Okay, let's make it count. So you have to be a little hands-on, for the next 120 minutes. So I'm going to come back to equity, and you would appreciate the fact that the course called CFA is not an accounting driven course. It is really an investment driven course, and out of that, equity gathers the maximum percentage. What I mean by that, in level 1, level 2 and level 3, 15%, 25% and 10%. So if you add them up, overall, over 3 levels, it is accounting for roughly 50%, which is like a huge number. It's like a huge, so maybe, I will not be wrong if I say that after portfolio management, this is like the most important subject for your entire CFA. So maybe at L1, you would find that the weight is a little less, but nonetheless, you should not do this particular topic for the purpose of weight. You should do it with an objective of building up your basics. So the way I have arranged this, the equity valuation, which is your last reading, and the overview of equity securities are really the A category items. The market organization and security markets are like the B category. Maybe market efficiency is B/C. And introduction to industry and company analysis is maybe a C category, not because it is, not only because it is very easy, but also because not many questions come from this particular aspect. So this is really like the A+ category, which not only is going to talk about the practical aspect out of it. One important, point that I would like to raise here is, a lot of people think that equity is a practical subject. Well, I am not denying that fact. The only point here is that the questions are not going to be numericals all the time. The questions are going to be conceptual. Now, the moment the questions are conceptual, the theory comes into picture. Maybe they may be based upon the practical aspect, but you may not have to use calculators as much. So students sometimes, for at least these 5 readings, come out pretty disappointed out of the exam and saying that the practical wasn't tested enough. As a matter of fact, CFA is a concept-driven course. It is not a numerical-driven course, except with quants and portfolio management. Okay, so keep that in mind, and focus upon the concepts, more. Okay, so let me just move to the next part, and here I would like to focus upon a very, very important aspect of financial reporting and analysis. Now, as you can see the list of topic, it'll tell you the story itself. Just think about it. There are about 9 readings, and honestly speaking, I haven't really looked at the way it is being clubbed in the book or your curriculum books, CBOK as we call it more fluently. This is your study session 7, which talks about only the overview and the basics. For people who are sciences, this becomes a very crucial stepping stone because this helps them to understand the balance. But for commerces, maybe this is not a very, very difficult and interesting thing to look at. But yeah, from this particular aspect, the way it has been done is, this is study session 8. And then comes up to here is study session 9. The meat of it, the meat of FRA, which is 20%, lies in study session 8 and 9. Now here, it is very difficult to put a number against each particular reading. I mean, let's say if there are about, on an indexation basis, you guys understand what is indexation. If 100x are the number of questions that come up, maybe 70x are going to come from, these two, maybe 75. Now, out of that 70, how much is going to come from each one? It's a little difficult thing to say. But yeah, through experience, I can say that these two appear to be the most important readings from an exam standpoint. 4, because cash flow statement is like the bread and butter for an analyst. I mean, he has to do valuations based on cash. So overall, if you look at it, it is extremely, extremely crucial for the analyst to be master of cash flow statement. There is no doubt in my mind that you can be a master only when you look at the income statement and balance sheet in detail. So in a way, understanding of 2 and 3 is extremely critical to look at 4. But yeah, I mean, at the end of the day, the questions are going to be more focused towards cash flow statement. Very, very intensely tested topic. This is important because it contains ratios. The beauty about ratios, as you would already be aware, you would have done some questions already, that ratios come with different topical aspect covered in different chapters. For example, they will ask a question about long-lived asset, but the way they will ask is it will also have ratios included in it. So overall, if I look at it, ratios should not be treated as a separate chapter. It gets mixed up in between somehow. So ratios is to be doing in a very, very important and detailed fashion. Okay, so that's how I would like to do it. And yeah, one very, very critical aspect is the last study session 10. Now, as a trainer and mentor, we get almost like 100 requests every session as to should we do this particular study session. This is very boring. This is very analytical. The question is that, agreed, there's no denying the fact that it is not very important. Maybe in category wise it is a C category item, but because of the weightage, which is 20%, which is almost 1/5 of the entire exam, even C category items get good number of questions. So maybe 4 to 6 questions you can expect from this particular study session. From a point of view of weightage in the exam, this may not sound to be great, but from the point of view of confidence that you would get if you get all these right, these are very. Now you have to appreciate the fact that it's a matter of confidence in the exam. So if let's say you get 4 questions which you are unable to do, what you lose is not the number of marks, but the confidence, and this is going to impact on your other modules as well. So keep that in mind. Don't, really overlook this particular aspect. This needs to be done not in a very intense fashion, but yeah, this needs to be at least read 2 times before landing into the exam hall. First, obviously to get some idea, and second, once you have an idea, you can think about it and kind of analyze it a little bit. So again, let me just clean the board a bit and talk about different aspects. I'm going to focus from the question standpoint as well. So I'm going to focus some part here, and I'm going to channelize my energy in the second half. Okay, let's just look at the last but not the least, clearly not the least, and that particular topic is ethics. After looking at your FRA, I am at ethics, and ethics again takes 15% in level 1, 10% in level 2, and again 10% in level 3. These are the particular topics that are being tested here. The standard for professional conduct, the most important aspect, and the codes of ethics, and your GIPS. So there is no, you would see, there is no C category item. There's absolutely no C category item. Now, why does that happen? is that ethics is very, very intensely tested topic in the exam. What I mean by intensely tested is you flunk in ethics and you flunk the entire paper. I will be as direct as this. What I mean by this is, you know that there are three bands, 0 to 50, 50 to 70, and 70 plus. Now, we assume, and as a mentor, we always, tell this to all the students that 70 plus is something that you should focus upon because that really is the safe zone. 50 to 70 is a little doubtful, but yeah, I mean, that's also like a, a orange light. It may not be a green light, but it may still be an orange light. What is going to be a red light is 0 to 50%. So it really depends upon. So, and an important point is, for the benefit of everyone, as a CFA institute, they never disclose, what exact percentage have you got in a particular band. So for example, student A got 49, whereas student B got 1%. Both will see that they are falling into the first band, which is 0 to 50%. So, as such, if you see that there's a huge amount of difference between the marks and the performance and therefore the final result, but what the student get to see is just the band that they are falling into. So that said, there is good amount of subjectivity. Keeping that in mind, that leads us to a scenario, different scenarios. I'm going to plot scenario 1. You have 70% plus in 9 subjects, but you have 0 to 50% in ethics. You flunk level 1. Scenario B, you have 50 to 70 in, let's say, many subjects, and ethics is also part of this. And you have 0 to 50 in a couple of subjects, maybe 2 to 3 subjects, then also you pass. So that brings me to the point that covering ethics is extremely, extremely critical. You have to be very, very careful that you do not fall into the first zone as far as ethics is concerned. The questions that you are going to practice have to be from CBOC. The questions are like case studies, small caselets, about 50 words, but the practical application happens. So I'm going to talk about how to attempt the questions, as when I look at the ethics, in detail. So I hope that I've been able to sensitize you guys about the the importance of ethics from the exam standpoint. So I think with that, I am good to start with my first detailed topic, corporate finance, and I'm going to devote about, let's say, maximum 15 minutes on discussing these specific aspects. I have a rough sheet here, on which I can do some calculations, and I would expect you to, follow me, here. I have a beta 2 calculator by Texas Instrument. For like a basic hygiene, point, you are not allowed to use any other calculator except the ones which have been allocated and allowed by the CFA Institute. So please, take that with a lot of importance, and maybe you got to really buy those calculators itself. So with that, I'm good to start with corporate finance, about 7% as far as the course is concerned. But yeah, from an understanding point of view, again, very, very important. So we saw that there are about 6 readings, 2 are A category, B category, and C category, or the balance. So from the capital budgeting, there is a concept called NPV profile. Now this NPV profile is again a very, very important aspect, and deliberately I haven't used a slide for each one, because then it becomes very difficult for me to cover everything up by then. So I'm going to talk about the NPV profile, and we also have a question in corporate finance which will look at this. So let me just quickly jump onto NPV profile by changing the slide here. And the slide here that I'm going to change back to is here. I'm going to draw a quick curve. And what is an NPV profile? Now, to do NPV profile, the fundamental of NPV and IRR has to be very, very clear. Just a quick point, IRR is the rate which you earn from the investment. It is the rate at which your investing cash flows, the present value of which is equal to the outflows of the investing timeline. By investing timeline, I mean the cash flows which you expect to make from a project. So there's like an outflow here, and there are going to be some inflows. So the R of an investing timeline is your IRR. What is an NPV? You are absolutely aware. If I use the cash flows of the same timeline, rather than discounting through the same R, I use the rate of your borrowing cost, so which is your financing timeline. So you have invested this money, but you would have borrowed this money from somewhere. Now this borrow that you've done is called as the financing timeline. You would repay it to different people depending on the source. For example, if it's like an bond that you have taken, so 100 is the issue price, you would repay some coupon, let's say $5, and then towards the end you're going to redeem whatever is a par value. So the R of a financing timeline is nothing but your cost of capital, and R of an investing timeline is your IRR. Now what is NPV? NPV is the present value of the cash flows from investing timeline, but the rate which is being used is of the financing timeline. So that's like a quick basic about NPV and IRR, very, very critical and fundamental point of view. So let me just redraw that. And an NPV profile is basically the relationship between the dollar NPV and the different rate percentages. So there is like a downward negative inverse relationship between the two, the NPV in dollar terms and the rate. The reason for that is that NPV is PVCI minus PVCO. PVCO most likely is at T0. So if you increase the rate, the present value of the cash inflows keep on going down, and as a result of which your net present value keeps on falling, because PVCO anyways has been insulated, it being at T0. So there's like a downward slope. And another important factor here is, let me change the color of the pen. The sensitivity of the NPV with respect to rate may be different. Now this is like a flatter curve. A flatter curve denotes a lesser slope. Lesser slope as in the change in y upon change in x is lower, which means that NPV is less sensitive. The reason for that maybe is that the cash inflow here are closer to T0, and for steeper axis they may be far from the origin. Now a very, very important aspect here is that these points where the NPV curves intersect, they are nothing but the rate at which NPV becomes 0. So these points become the IRR. So so this is for IRR project, let me call it A, and let me call it B. So this is IRR A and this is IRR B. I'm going to put some numbers to it for the ease of convenience. This is 0%, this is 12%, this is, let's say, 15%, and obviously this continues up to infinity. Okay, so here I have range number 1, range number 2, and range number 3. In between I have another range. This is the rate, maybe let me take an example, 8%, at which the NPV of both the project, I'm taking a random example, $400, is the same. This rate is called as the crossover rate. So in a way, I now have 4 ranges. The range which is 0 to 8, 8 to 12, 12 to 15, and 15 to infinity. The question that comes from NPV may be from any particular point, where it may be a 360-degree question, wherein maybe, let me just complete the basics. So if the projects are independent projects are one where anyone can be selected without having any relationship to the other project. So if the projects are independent, I'm going to select both A and B here because both have a positive NPV in this range. I'm going to select A and B again here because both have a positive NPV here. Now in this case, in the third range, the black curve goes below the x-axis. So I'm not going to select A. I'm going to select B only, the flatter curve. And here I'm not going to select B as well, because in the fourth range even B has got out of sync. If the projects are mutually exclusive, then I can choose only one. So the choice is very clear. I can select only B here because that's the only project which is a good project. Otherwise, project A anyways is making a loss here in terms of NPV. But what is critical here as to what happens in this particular range between 0 to 12. From 0 to 8, it is project A whose curve is above the curve for project B. So in this range I'm going to select A. Okay, if this is to be selected, this curve you would see is below this black curve. So if I select B, being mutually exclusive, I can select only one out of the two. So by way of selection, I can select project A here, and in this particular range I will select project B. So that's how I would love to make a quick selection out of that. Okay, there's in the meantime there's a question from Sunny here which says that which is the calculator that you would suggest for the exam. Now there are two calculators which have been prescribed, Beta 2 Plus and Beta 2 Professional. So Sunny, to answer your question, I think you can choose any one. Honestly, there are a couple of functions which are there in Beta 2 Professional which are not in the lower version, but overall, if you look at it, this really is not a matter of life and death. It's like absolutely similar functionality. Whichever is available, at convenience to you, you can kind of refer to that. Okay, so that's like your NPV profile. The way it looks to me, and it's like very, very important question. The question maybe, read the question very carefully, whether the question is asking about an independent project or it's asking about the mutually exclusive project. Read the question very carefully, read the language of this particular question very carefully. NPV profile as such is a very, very, tested in a very, very confusing manner. What these points suggest is the NPV if the discount rate becomes 0. So this is really PVCI minus PVCO. If the discount rate is 0, then really the present value is equal to future value. So this is really the undiscounted sum total of cash inflow and undiscounted sum total of cash outflow, being calculated. So overall, this is like a very, very interesting graph to look at it, to analyze it, and to make questions out of it. So if I were the examiner, I would post at least 3-4 questions out of that in a very, very interesting fashion. Okay. So with that, I'm going to look at the next confusing topic here, which is the marginal cost of capital. Now, what a lot of students commit mistake, and may not be mistake, but yeah, I mean they get a little confused about, is what is the relationship between marginal cost of capital and the WACC. And I would want to explain this by way of a small matrix. What you have to understand is the number of sources, single and more than one. Okay, and the capital, the time horizon. Have you already raised that capital, or you are about to raise that capital? Futuristic. Okay, so what I'm trying to say here is that when there are more than one source of capital, you have to average them out, and that is called as weighted average cost of capital. It has got nothing to do with whether it is historical or futuristic. Weighted average means you have more than one observation, you apply the weighted average, pretty much like an arithmetic mean, using the weights. So that's how you calculate WACC. What is futuristic is marginal cost of capital. So as you can see that MCC and WACC are not apple to apple, in a way. If you are planning to raise that means futuristic to raise capital only through one source, then you fall into this quadrant. If you're planning to raise a capital for project, for let's say a project that you're expecting to do, by more than one, then you fall into this particular. So it is going to be WACC, but it's going to be a futuristic WACC. MCC has got nothing to do with whether it is for a single or it is for more than one source. So please don't get confused. Marginal cost means cost of borrowing one more rupee. If you're borrowing one more rupee in a single fashion, then I fall into this quadrant. If you are raising 1 rupee as a weighted average of more than one source, then I fall into this particular quadrant. Historical cost, when I write here, means that the cost of the source that you have already raised. So if you calculate for any individual source, cost of debt, cost of preference, cost of equity, then you fall into this quadrant. But if you calculate at using the weights and you put an average to it, then you fall into this particular. So please don't get confused with this concept of what is marginal cost and how is it different than WACC. They're not apple to apple in the respect. What you have to understand is that for the capital projects, the capital budgeting is all about planning, and planning is futuristic. You are wanting to raise some extra capital for it, so you fall into this particular zone. Now read the question carefully. If the question is wanting to raise money only from one source, then you calculate the single source MCC. But if the question says that equity and debt will be in a particular proportion, say X to Y, then you fall into this proportion. But please, let's say whatever the number, let's say 18% is the MCC comes into picture, and that will be used as the discount rate for this project. 18% is both a WACC and 18% is both a marginal cost of capital as well. So please don't get confused, the way it is being done. Okay. Now, in the meantime, Benjamin has raised a question. Let me just quickly go to that. It says how to determine the crossover rate. Now, Benjamin, on the previous topic is what you have asked. Crossover rate, let that rate be X%. Okay, and using the NPV, using the cash flow pattern, you calculate the the NPV. You create an equation, let's say there are 100, 120, 140. This is just to answer Benjamin's question as to how to determine that X percentage. One way is, you look at it from the graphical point of view, and whatever is a graphical intersection becomes the rate. But practically, it is going to be a little difficult to plot a graph and find that number. So we do it by interpolation, which we do it after hit and try. Okay, in the exam, you will not be required to calculate the crossover rate. It will be 99.9% given to you, or a conceptual question is going to come in. But practically, to answer your question, Benjamin, it will be done by interpolation. So let's say there are two cash flow patterns which are given, inflows and outflows put together, project A and project B. Now, what you will do is, you will take the first hit at 10% and calculate the NPVs, of that. You will again take, let's say, a hit at 12% and will calculate an NPV. So, between the two, you will do some interpolations and you will be able to, find that out. So, from an exam point of view, I don't think this question is relevant, from a numerical standpoint. But yeah, from a practical standpoint, this is a good question that you've asked. Okay, so. So that's your marginal cost of capital, and it will be used in your future project evaluation. The next point is the breakpoint, and again a very, very critical aspect. Breakpoint is something which is related to the marginal cost of capital, and at the same time it is related to weighted average cost of capital as well. Now this is something which needs to be understood in detail. Let me go to the rough page again, to explain this particular aspect. Okay, good. Now, you all know that WACC is equal to KD, of course 1 minus T, weight of debt, plus cost of equity, weight of equity. Now, for simplicity's sake, I'm just, making the weights of debt to equity constant, let's say 40% and 60%. Breakpoint is basically a concept wherein we are clearly raising a futuristic capital. We are not talking about anything historical. And B, we are talking about generally more than one source of capital at the same time. So if I were to ask you a simple question, when will this WACC change? This WACC has got 4 components: KD, WD, cost of equity, and weight of equity. Out of that, 2 I have put as constant. The weights have been put as constant. So your answer to my question will be WACC is going to change when either KD changes or KE changes, and change here means up and down. Let me correct that answer. When KD changes, when KE changes, answer is when either of the 2 changes. They both don't have to change at the same time. What I'm trying to say is if the KE doesn't change but KD changes, then also WACC changes. If KD remains constant and cost of equity changes, then also WACC changes. So breakpoint is basically, if I were to kind of put a graph for that, it's a very important and conceptual graph. So if I were to put like WACC percentage, obviously this is futuristic, so this is in a way MCC as well, and this is for more than one source, so therefore it becomes WACC as well. So here amount of capital. So as the amount of capital increases, you are aware that cost of debt also go up because of the financial leverage and the costs associated with it, and cost of equity, that also changes. So the KD and KE goes up, so in a way the WACC would also go up, but the WACC will not go up as a straight line. For a particular source, let's say 0 to 100, the WACC is going to be same. What you have to remember here is that the concept of breakpoint is a very important aspect. The concept of breakpoint is at total capital level. Breakpoint is that amount of capital. Breakpoint is that amount of capital. If this is X, so these are different X's, X1, X2, X3. These are different amount of total capital at which the curve of the cost of capital shifts. Theoretically, it might go down as well, but practically it generally goes up only. What you have to understand is this 100 is not the money that I have raised from debt. This is neither the money that I have raised from equity. This is the total capital that I have raised in this particular ratio. So again, bringing back to the concept, when will this WACC change? When either KD changes or KE changes. So if I look at it, X1, when the total capital is 100, my debt would be 40 and my equity would be 60. So it is absolutely, critical to look at that either debt or equity or both, one of the two has changed. If it is debt, then it would have changed at 40 level, and it is equity, it would have changed at 60 level. What I'm trying to say here is that maybe the debt schedule given by the banker to us is like that. The dollar bought and the percentages at which it is bought. So if you borrow more and more debt, the cost of debt is going up. So 40 is the threshold. If that crosses, then obviously at 40% the total capital will cross 100. So if the debt crosses $40 threshold, then it is going to give you a change in the cost, and that's where the concept of the break, it's like a smooth curve flowing from left to right without any problem, but there's been a speed breaker here. That speed breaker is a break which is coming up in this curve, and that break is because of change in either the debt or the equity. So if I were to kind of ask a question that if let's say the debt has this kind of a schedule, so there are about 1, 2, 3 and 150 plus, so there are 3 breaks that are going to come just because of debt, because the moment your debt is going to cross 100, the total capital is going to become 250, debt always being 40%. If it is crosses 150, then obviously again it is going to be a break at 375. So there are 3 break points that is going to come up just because of debt. A parallel schedule would be there for equity as well. So the number of breakpoints that a firm experiences is the summation of the breakpoint because of debt and the breakpoints because of equity. Very critical point here. Sunny has also raised a theoretical point here that WACC can also change if the tax changes. Honestly, Sunny, when you forecast it, you generally don't take into consideration the assumptions of tax changing. You assume the tax to be constant, all throughout. Okay, so with that, I am good to go to the next point of corporate finance, which is a relatively easy and sometimes confusing point of pure play method of finding beta. Now you would understand that beta is a measure of risk, and we're talking about beta equity right now. So by beta equity, the idea is that you guys are looking to find out the risk. Okay, so beta is a measure of risk. So let me again go back and give you a quick context for this beta thing. I'm going to take example of a company called as Apple. Apple is into the handset manufacturing and technology and all that space, and Apple now suddenly wants to go into automobile. Here is a company, Ford Motor, who is purely into auto. Okay. Apple wants to evaluate a project. These are the cash flows, maybe 50, 100, 80, whatever is the number, and there is an outflow of 200 which they have thought. So this is like a cash flow that Apple has projected in the auto industry. What Apple now wants to know is what should be the discount rate. Well, it is very simple that a discount rate has to be WACC. For WACC, you need to know cost of debt and cost of equity. So from a banker, I would be able to get cost of debt. But the cost of equity, let us say I am expected to calculate from CAPM. For CAPM to happen, I need to have the beta equity with me. Now, beta equity has got two types of risk. One is the operational risk, which is because of the industry, which in this case is automobile, and the other one is the financial risk, which is the capital structure, maybe because of the debt of equity of this particular case. So while I said WACC means there is a portion of debt and equity, so that's where the financial risk comes into picture. More importantly, the point here is that the beta equity used to evaluate this automobile project should have the operational risk coming out from automotive, of which the worst part is Apple has no experience. So, and this particular project is not listed. So therefore it is very difficult to find out the beta equity, the risk of equity when the Apple shareholder invest into this particular project. So how do I get to a relevant beta equity so that I can get to the CAPM equation to calculate cost of equity for my WACC so that I can do my capital budgeting? That's the way the chain gets built up. Okay, so I need to calculate beta equity to get to cost of equity to calculate WACC so that I can use it as a discount rate. The question is, how do I find out the risk from the new industry? I look at a proxy. And the proxy has to be the one which has got absolutely pure experience of the desired industry that I want to get into. Please don't select a conglomerate. This particular proxy, beta of Ford, will be driven by operational risk of auto and the debt and equity of Ford Motors. Now obviously the debt and equity of Ford Motors need to be removed. So the way I'm going to do is, step number one, I select a proxy which is my Ford Motors. The beta equity will be taken from stock exchange. That beta equity will be unlevered. I will have to remove the financial risk. So the moment I remove the financial risk from it, my beta equity becomes beta unlevered. And in the third, the beta unlevered needs to be relevered. That means the financial risk have to be added, and this time of the desired company, which is subject matter company of Apple. So the way you're doing is you are removing the financial risk of the proxy, and you are again adding the the financial risk of the subject matter company. What you're trying to do is beta equity is converted into beta unlevered, which is going to be same for all the auto companies because the operational risk remains same, and because of the difference in the financial risk, beta equity of Apple to be used in auto will be calculated. So pretty important and interesting aspect. The formula that you're using remains same, which is beta unlevered is equal to beta equity E upon E plus D 1 minus T. There are different versions of this formula, which is obviously not very difficult to understand, because if you divide everything by D, the numerator and the denominator, so if you divide everything by sorry, not by D, by E, so this is going to become 1, this is going to become 1, and this is going to become debt to equity. Okay, and obviously, if you want to take the denominator up and numerator down, you can obviously switch it, in different ways. So that's how, the pure play method of, finding beta is there. So let's just quickly wrap up this and calculate what is operating cycle and net operating cycle. I'll come back to point number 5 here. Your operating and net operating cycle, whenever something called as net is written, it basically means that something has been deducted from some other aspect. So let's say net revenue means revenue minus discount. Net profit means revenue minus cost. So net operating cycle means operating cycle minus creditor payment cycle or payment period. The question is going to prick you on a question. Let me give you a sample question. The creditor payment period goes up. What is the impact on operating cycle? Now there is a tendency to write that if the creditor payment period goes up, the operating cycle goes down. Whereas as a matter of fact, the operating cycle is a sum total of inventory plus debtor. It has got nothing to do with the creditors. Okay, so keeping that in mind, it is extremely crucial to be very, very strong on the formula. But yes, if the question would have been, if the creditor payment cycle goes up, what is the impact on net operating cycle? Now, net operating cycle has this particular aspect also in the formula, so it is extremely, extremely crucial, to be very strong on the formulas as such. Okay, let's jump on to point number 5, and after that we'll do point number 7 and quickly jump on to some of the questions that we will select selectively. The effect of share purchase. Now what is share purchase? Is basically buying the shares, the existing shares from the market. So overall impact of that is the cash goes out of the system and the capital reduces. So that's broadly a equation of your buyback. So the reserves go down and the cash also goes out. The question is, what is the impact on the EPS? Now the impact on the EPS is earning attributable to equity shareholders divided by number of shareholders. By this buyback, the number of shareholders certainly go down. There is no doubt that they go down. The question is, the earning attributable to equity might go down or might remain constant. It will depend upon if the cash which has been utilized to buy back has been kept idle, then obviously it was not contributing anything to these earnings, and therefore the earnings will remain constant. But if the cash was being invested somewhere, then in that case, there will be some fall in the earnings. For example, this cash was so far invested in the FDs, and FDs were giving you, for example, 8% of your per annum return. So if you have used $100, then this earning attributable to equity is going to go down by $8. But overall, it has been seen empirically, as well as conceptually, that whenever you're funding the buyback using the own funds, then the fall in the denominator is considerably more, and as such, the EPS always increases. However, when the buyback is funded by the borrowed funds, then essentially what you're doing is you're replacing one source of capital from the other. You are increasing the weight of debt and reducing the weight of equity. and it will depend upon what is the cost at which you have taken the debt and what is the cost at which your equity was coming so far. So overall, if I have to summarize that, I get to a point that if your cost of debt is more than cost of equity, then obviously your EPS is going to go down. If cost of equity was more and you have replaced it with a cheaper source of capital, which is going to be the most likely scenario, then your EPS is going to still go up. Okay, so you have to look at it in a very, very specific fashion. And another important aspect here is that the cost of equity cannot be calculated by Gordon, cannot be calculated by CAPM, cannot be calculated by bond yield premium. It has to be calculated as earnings yield. That's a very specific point that you guys have to note down. That when you're comparing this cost of equity with KD, then you got to make both things after taxes and you got to calculate EPS in this particular fashion itself. Okay. The effect of buyback on book value is pretty straightforward. Let me give you a mantra. Market price and book value per share. Whatever is the difference is going to go up. What I'm trying to say is, if market price is above book value per share, then the difference is going to go up. The market price is going to remain same and the book value is going to go down. If on the other hand, by chance, book value per share was more than the market value per share, before buyback, then also this difference is going to go up. So while market price will remain same, the book value is going to further go up. So it really depends upon the pre-situation as to, what is the, final, result on the aspect. So I have a, quick question here coming out. Let me just quickly, attend to that. Let me just read out the question for everyone's sake. Nitish Mishra is asking, I went through a question stating equity beta and asset beta be equal. How can that be? Nitish, that is a scenario if your risk of equity is equal to the overall risk that you're facing, and that will be a scenario where the debt is equal to zero. If you recall that there are two types of leverages, the operating leverage and the financial leverage. So if you're saying that operational risk is equal to the total risk, then obviously that means the financial risk doesn't exist. So to answer your question, Nitish, equity beta will be equal to asset beta or project beta or overall beta only when the debt is equal to zero. Okay, so I hope that answers your question. Okay, how basic? Because I'm okay. Bhagyashree has attended, late. So Bhagyashree, we have talked about little bit about FRA, CorpFin, equity, and ethics, the prioritization of different subjects, and we are at corporate finance, almost closing in, trying to talk about different confusing aspects here. Okay, so welcome Broad, and try and catch up with corporate finance. Pretty easy stuff, pretty basic stuff, but very fundamental stuff, is what we're doing. So maybe the last leg is what you can join in from. So let's talk about the seventh aspect, which is the aspect about the cost of trade credit, and that brings me to a very, very important aspect of the way it is written, the nomenclature of it. So typically the terms of dealing is 210 net 30. It basically denotes different aspects. Let me just change the color. Yeah, so this is the credit period. If nothing is mentioned, then the payment has to be made in these these many days. This is the cash discount period offered, that if you pay within 10 days, then you are going to get the amount of discount. Amount in the sense, the percentage of discount. Okay, so if you have to pay in 10 days, if you're able to pay your creditors in 10 days, then you don't have to pay entire 100. You can get away by paying only 98. So it reads as, you made a purchase here. If you don't do anything, you pay entire amount here, but if you pay within 10 days, you get a discount of 2, so you pay only 98. What you have to understand is creditor has given us a term 98 at T10 is equal to 100 at T30. That also means that I have to bear a cost of $2 for not paying for 20 days. Think about it. Just by paying 20 days late, I have to bear a cost of $2. So this is also equal to a scenario where I am borrowing some amount at T0 and I am repaying that along with the interest. So $2 act as an interest on a loan of 98, and 100 becomes the amount. So the way I look at it, the concept of holding period return can be also used to calculate holding period cost. So the cost for this 20 days is 2 upon 98. A quick calculation onto my calculator, 20 upon 98 is 2.04%. Okay, but this is just the cost for, this is not per annum, this is only for 20 days. You got to annualize that, by again the same formula. Effective annual yield can be calculated also as effective annual cost. So it is 2.04 raised to the power 365 upon 20 minus 1. So in your books there's like a complicated formula given about annual period divided by the total credit period minus discount period. You got to understand that this particular discount period has got no role to play. It is only the balance 20 days which is at play right now. So please don't forget that you have to write 30 minus 10 or in other words 20. This concept is absolutely same as holding period return. Ultimately we're talking about the percentages, maybe of a borrowing timeline or of an investing timeline. Doesn't really make good amount of difference. So with that, I'm absolutely towards the end of corporate finance. Let me quickly jump on to a couple of questions that I would like to do with you. So the questions that we're able to see is like a commonsensical question. The first of that is, two projects have the following NPVs, 4500 negative and 5500 negative. If the projects are mutually exclusive, which one of the following will you choose? Okay, now I'm not reading the second half of it so far, so just answer by way of your the chat that you can do with me by posting questions in that window. I would want to hear the answer of this particular question. If the projects are mutually exclusive, you are supposed to choose the one with greater NPV. Now I want you to quickly answer that. So I have answer coming from Karan, Ashish, Tanay, Sunny. Different answers are coming up at different point in times. And the answers are also different. So I would expect everyone to quickly answer that. If two projects have got negative NPVs, which one of the two would you finally select? Now in this case, okay, fine. So I think let's just stop here and look at the question again. You have to understand that both the projects have negative NPV. So all those who have answered either project A or project B are incorrect, because think about it, both the projects you're making a loss. For a mutually exclusive project to be selected, it is extremely important that they have at least a positive NPV. You need to find the best, but the best has to be out of a good lot. You first need to select which of the projects are good projects. Only then you will be able to select the best out of those. So the answer of that is we will not select any project. And what will your answer be if the projects are independent? Then also my answer will be that I will not select any particular project, because obviously both are giving me a negative NPV. Okay, so let's jump on to the second question here, and for that you will have to do quick calculations with me. This is a question that you have. The two projects being considered by a firm are mutually exclusive and have the following projected cash flows. So you have year 0 to 3 different projects. What you have to find here is, we don't know for project 2 how much is the outflow. What I know for sure is that the crossover rate is 9%. Question is, how do I find out this particular aspect of the outflow that you have here? Well, I give you 30 seconds to do that. Just utilize this particular feature, or should I say the characteristic which is being given, crossover rate. What was crossover rate? If you recall, it is the rate at which the NPVs are same. So the way to do is, let me just give you the methodology. Maybe the question is not so important, the answer is not important as much as the methodology of doing that. If I calculate the NPV at crossover rate, the NPVs of both the projects are same. So let me just write for project 2, NPV is equal to PVCI minus PVCO. This at 9%, and NPV is equal to PVCI minus PVCO. This is for project B and this is for project A at 9%. But you have to understand that at crossover rate, these two will be same. Let us quickly calculate the NPV of project A at 9%. So my 4 being the outflow, 4 becomes the CF0, and CF1 is 3, CF2 is 5, and accordingly okay, so you're getting an answer. Let me just quickly do that. So how much is the answer that you guys are getting? 0.09. I am getting an answer of 4.51. So 4.51 is also the NPV here. I can calculate the PVCI. Oh, now I can calculate the PVCI here quickly at 9%, 5.8, 8.73. So PVCO becomes a balancing figure of 4.22, something about it. So that's how you're going to find out utilizing the aspect about the crossover rate. And this is what I meant when I said that the question might ask you anything from different point of view. So this is question number 3. Is pretty straightforward question. The only thing is that the cost of equity could be asked to calculate from any particular source. So in this question, the moment you find beta being given, you know that you have to use CAPM. If constant growth would have been given, you would have to calculate it through Gordon's growth model. Okay, so this is something which is extremely critical. And with that, I am at my question about the pure play method, wherein I'm going to talk about a very, very interesting example of Copal Incorporation, my subject matter company, who is wanting to expand into a new project. So Copal's capital structure is 75-25 debt, 75 debt and 25 equity, and the tax rate being 30%. So that's my subject matter company. There's another proxy which is a publicly traded firm, Aspire Brands, and they already have a good amount of experience in the recreational sports product. They have a equity beta debt to equity of 1.7 and a beta equity of 0.8. So like I said, you got to, from this 0.8, you will have to reduce the financial risk of the proxy and add the financial risk of the subject matter firm. So it's like pretty straightforward. What you'll have to take into account is, while you're removing the financial risk, you have to use the figures of the proxy, and while you are reloading it, you have to use the figures of the subject matter firm. So this is like a simple straightforward point which I am kind of skipping for the moment because of the time and all. What I would like to devote my time is on question number 5, which is pretty interesting, and that's going to be like pretty much my last question for corporate finance. Herein question, just have a quick read of that. not a difficult but a very fundamentalist question, that the share price of solar automotive industry is $50 per share and has a book value of 500 million. Okay, and 50 million shares are outstanding. What is the book value per share after the repurchase of $10? So this is the total budget for repurchase, and from that, you have to now calculate the new book value. So the new book value per share is equal to old book value minus the cash which is being used divided by old share minus the shares being bought back. So this is like a simple straightforward formula. So let me just calculate these figures. It simply states as to whatever is the worth, the net worth remaining with the company divided by the number of shares which are remaining with the company. Okay, so let's quickly calculate the old book value, which is given to be 500. The total cash which has gone out is 10. You have to use the units very carefully. This is also million and this is also million, and the number of shares that you had are 50 million shares outstanding, out of which how many shares would have been bought back is a question. So if I talk about in million, there were 10 million dollars used and 50 per share, so overall 0.2 would have been bought back. So I get a number 490 upon 49.8. 490 divided by 49.8. A quick calculation tells me it is 9.84 dollars per share. That also gives you a point, the analytical point that was that in this question the market price of 50 was greater than the book value per share. The book value per share was 500 divided by 50, which is 10. Okay, and we had learned a basic that whatever the difference be, the difference is going to increase. So the market price is going to remain same. Book value, which was lower than the MPS, is going to further low down. So from 10, it has become 9.84. So that also tells you that the basics that you've done so far, are pretty correct. Okay, so with that, so this is like pretty simple and straightforward. The same invoicing, the questions that we had done. So with that, I am absolutely good to go back to my basic PPT, and herein I'm going to talk about let us say FRA, or maybe for the change of topic, I would want to select with equity first, it being a smaller topic, and I hope to cover that up in the next 15-20 minutes fairly quickly. So I hope that the session which going so far are pretty good and okay. Oh yeah, so there is a lot of questions, they have been answered by Nitish and Karan. So I'm very pleased to tell you that Nitish and Karan both have got the right answers to the questions that we have been doing so far. But my request to everyone is that please, everyone has to participate, because that's the way you really have to, apply yourself, in the exam as well. So maybe even if, you believe that you are not fully prepared for a boot camp like this, so, please, my request will be to participate as much as possible, so that it is helpful for everyone, and it's like the hands-on experience that you have to kind of get through topics like these. So so coming to the second topic of equity, and you're aware that equity is about 10%. 10% meaning almost 18 questions are expected out of that in each attempt. Most of them will be theoretical or conceptual, should I say, and only the first aspect is going to be the practical, which is the equity valuation. So there are 5 topics that I would like to take it up. The smallest one is the definition of peer group. Now this is part of the industry and company analysis. Therein there are 2 types of grouping that we talk about, and that's where the student gets confused. A peer is not a comparable always, or should I say a comparable is not a peer all the time. A peer is a company which has got these three things to be same, BEC, the business activities, the economic driver, and the cost structure. You have to really learn the peer group as B, E, and C. A peer 99% times is a comparable, but a comparable may not always be a peer. You have to understand that in a way that the business activities of two companies may still be different, but sometimes you still use them as comparable because there is no other proxy, a close proxy available. Sometimes earlier times we used to compare Apple with General Motors, before General Motor kind of went on for bankruptcy in 2008, because both were global leaders in their respective industries. So sometimes you tend to draw comparables. So that's where a comparable is, but it is not a peer group because the business activities, economic structure, and the cost structure are very, very different. So that's where the role of a peer group is different than a comparable. Let's look at the justified value and the calculation of intrinsic value. The intrinsic value has got different names. Now understand them very, very carefully. It is called as intrinsic value because security. Intrinsic means the core. Core means what is there in your heart. So that's really not the heart that you're maybe some of you are referring to. This is really the core strength that that you're trying to build in. Here it is also called as the justified value and also called as sometimes the fair value. Now read the question very carefully. This all is not different. This all is different. It's not same as MPS. What you have to understand is all these should be the value, and this is analyst specific. This is always analyst specific. It depends upon the assumptions, the rates, the cash flows which an analyst have to follow. If there are 100 analysts, it is possible that the same instrument would have 100 intrinsic values. But the market price is the actual, as is, same for all. This is something that you calculate your IRR as. This is the outflow that you have to, everyone in the world has to invest, and based on the future cash flows you calculate the rate. So the rate is not dependent upon the justified value, but is dependent upon the IRR, etc. So please you have to be very, very careful, and that brings me to a very important matrix that I want everyone to draw and make. These are the different present values and these are the different rates. Okay, please start drawing simultaneously. It is very, very important. If let me put it this way. What does okay, hang on. Let me just redraw that. This is the present value and this is the rate percent. This is what the market calculates and this is what the analyst calculate. Now there are two present values that you always encounter in the question, and there are two types of rate that you will encounter in the question. Okay, the rate which an analyst used is the required rate, the risk adjusted rate calculated by the CAPM or Gordon or whatever it is, but this is the rate that an analyst think. Based on that, the present value that an analyst calculate is called as a justified value or the fair value or the intrinsic value. Okay, so in a way, beg your pardon, there is no connection here. So in a way, the required rate determines the justified value. But when you're talking about the market, it is absolutely the opposite. The order of calculation is absolutely the opposite. What I'm trying to say is the market gives you the actual market price per share first, and based on which a rate of return is calculated, called as IRR, also called as YTM, also called as MWR, also called as I by Y of your calculators. So they all mean the same. This is the rate that you earn. That is a rate that is calculated on the basis of the actual market price. This is not determined and dependent upon the justified value. So I can find out the overpriced and underpriced either by looking at the present values. If the actual market price is greater than the justified value, that would also mean that the IRR is lower than the WACC. The required rate is also called as the cost of capital, the opportunity cost, or the WACC, or the required rate. These are different synonyms. So you can find out the overvalued security either by looking at the present value or by looking at a particular rate. The present value, if market price is more, it is called as overpriced. This is a scenario where the IRR will be less, and vice versa. So read the question very carefully. It is a very fundamentalistic point. You should not, go wrong on that. So you look at the different language, different words that is being used on a very, very, important point. So that concept covers point number 3 as well. My point number 2, which is the efficient market hypothesis. Let me just go to a next slide, and with that, let me just quickly ask a question. Nitish is asking about cyclical and non-cyclical companies. I will come back to it in a while. In the meantime, Karan is saying about, isn't fair value same as the market value as we have in FRA? Well, Karan, in this particular concept, the idea is to find out the overvalued and undervalued security. The mispricing has to be calculated. So in FRA, there is no such logic of it. In FRA, the two domains that we have are either what is happening in the books, which is the book value, and what is happening outside the book in the market. Now, this is basically the market value bucket, and this is the book value bucket, which is determined by the accountant's assumption. This is absolutely not equal to the concepts that we have done in equity. In equity, within this bucket, we are trying to differentiate between the analyst's value, which should be the market price, and the actual market price. So hope you will appreciate the difference. Justified value is also the market value, but it should be the market value. It may not be the actual market value. Justified value is also a proxy for market value. It is the value which should be the market price, but at the end of the day, we're talking at a market price level. We are not going to the book value level. Okay, so it is different than what we use in FRA. Nitish, to answer your question, the cyclical companies, yeah, absolutely. Tanay, you will be absolutely, given, we also have that in as a question, that you will be given a lot of questions to calculate the justified value. This is nothing but the present value of future cash flows, as simple as that. Justified value of any asset in the world is equal to the present value of future cash flows, full stop. Okay, so this is as simple and straightforward as it gets. Now to answer Nitish's question, what is the cyclical companies and what is non-cyclical companies? Nitish, just look at the top line. If the top line moves along with the economy, then it's a cyclical company, unless otherwise it's a non-cyclical company. For example, salt industry. You don't start consuming stock, or you don't start consuming more amount of salt just because it's a happier time. So economy is doing very well, so that you start eating a lot of salt in the vegetable. That's not going to happen. So the basics, which is either the defensive industry or the utility industry, those are typically non-cyclical. Some of the luxury items are cyclical. Automobile is going to be cyclical. Housing market is going to be cyclical. But let's say some of the consumer durables may not be cyclical, but yeah, I mean, some may be cyclical, like mobile phones are a cyclical industry, because at least the fancy mobile phones like an iPhone may be a cyclical industry. Okay, so with that gives me the point to go to my next topic of efficient market hypothesis. In that, I would just like to explain a couple of basics as to what you mean by efficiency. Efficiency is where all the securities are correctly priced. Justified value is actually the market price. This, like I said, should be the market value, and this is, like I said, is actually the market value. So efficient market is one where this phenomena is actually true. Okay, but this is honestly a hypothesis. No one really can foresightly talk about, whether the market has been efficient. So it's like a hypothesis which we try to prove or disprove. The efficiencies have got three levels: weak form, semi-strong, and strong form. And there are three levels of information that a market participant might have. The historical information about the price and the trade, which is called as technical analysis. The justified value based upon the future announcements, public information, called as the fundamental analysis, and the futuristic value, which is private information, also called as insider info. So these are the three different tools or three different levels of information that any market participant might have. And these are the three levels of efficiency. It has been tested that if the markets are weak form efficient, then anyone who has got technical analysis and the knowledge of it will not be able to make any money. The justified value has already taken into account the technical analysis wala part. But yeah, if someone is able to make a good forecast of the cash flows, or someone has an insider information, he will be able to make some money out of that. Then the mispricing will be found, and therefore it will be possible to make some delta with that, either by buy or by sell. As far as the semi-strong market is concerned, you are unable to make any money out of that. The price already takes into account the two things here, but it still not takes into account the insider information. That means to say that anyone who has the insider information will be able to make some extra money. Strong form basically says that the price takes into account even the insider information. So any person who has some private knowledge which will be made public tomorrow and has the capacity to alter the price, which is nothing but a material non-public information, that guy will also not be able to make any money. So we can clearly say that the markets are not strong form efficient, because there have been a lot of insiders and there have been a lot of scams by which insiders have made a lot of money. And yeah, the markets are supposed to be weak form efficient, but yeah, sometimes semi-strong, sometimes not so semi-strong. So that's what the efficient market hypothesis is kind of all about. So Tanay has asked a question that while calculating the justified value, do we really just punch in the cash flows in the calculator and find out the present value? Well, Tanay, the answer is absolutely yes. It is as simple as that. The only thing is the discount rate that you're going to use has to be relevant to the risk that you see in those cash flows. Okay, so with that, I am absolutely towards the end of this particular equity difficult topics. We have to just talk about the margin trading, and for that I'm going to go to again my drawing board, and we'll try and explain this particular aspect through a simple calculation. Okay, this is T0 and this is at the end of the year. The way I understand, and I would like you to also understand, is you're trying to buy an asset using the loan funds. The total value of the asset was 100 and you had only 40 in your pocket. So you have taken a loan of 60 from a bank. The value of the asset went up 20%. Okay, and obviously after a year you got to pay 10% as loan. So $6 is the cost that you have to bear of that loan. My question is, how much is the equity that you would get? So the answer to that is the equity will be 54. The return on equity will be 14 upon 40 is equal to, just do a quick calculation, 35%, which will be more than return on asset. This is so because leverage that has been created by the investor. Well, as you can see yourself, the leverage that has been created is almost like 2.5 times of it. Sorry, not 2.5 times, is 1.66 times of it. So let me just also connect few things here. 14 divided by 40, let me just quickly check the calculations. Yeah, it's coming out 35%. Now here, just understand that the return that the equity shareholders have been able to make is not only from investing in the asset, but they have to pay $6 as interest as cost of borrowing. So the total return that they have been able to generate is $20, 120 minus 100, but out of that they have to pay some share to the debt, okay, and maybe something as a brokerage cost. Maybe let's take a notional figure of 1, brokerage on selling. So the net profit that they've been able to make is 13. The important point here is that they don't have to spend entire 100 but only 40. So overall, if you look at it, that the return that they've been able to make is close to 32.5%. I mean, that 32 and 35 is because of that $1 of the brokerage that I have taken into account. So net your leverage return is nothing but the net take home at TM whenever you sell, divided by initial cash flows at T0. That initial cash flow not only will take into account the $40 of the money that you've put in to buy the share, but also will include the brokerage, etc., if at all that had to be paid. Okay, so keeping that in mind, I consider that, so the leverage ratio is equal to asset upon equity, which in this case is upon 100 upon 40, is equal to 2.5 times. So the risk that the analyst has created for himself is 2.5 times, with putting in 100 amount out of which only 40 belongs to him. Okay, and this exactly also is the margin trading, the ability to trade at a much higher value compared to your equity. So here, just a quick round of caution here. Margin appears to be the loan, whereas margin means the portion of equity. So the two types of margin, the initial margin and the maintenance margin. Initial margin is the initial proportion of the total that you need to put in, and maintenance margin is like as the trade goes on and you're still open-ended, then how much is the money as a percentage that you got to maintain. So that's fairly easy, and I'm not going to dwell deeper into that and spend more time for that. So I hope that the questions on equity are clear. So I am absolutely good to kind of look at the questions of equity. In the meantime, let me just take quick questions from Tane. Tane says, is FMCG not cyclical? Well, Tane, it sometimes depends upon the product. Now, fast-moving consumer goods, for example, like salt, or let's say, spices, are pretty non-cyclical. But if you look at, some of the, expensive biscuits, for example, ITC has come out with very, very expensive biscuits these days. These are sometimes used for Diwali gifting and all, so they are typically branded as FMCG, but if you look at it, that's on the higher end of the income segment. Now, so that kind of a product may not be non-cyclical. That may find some cyclicity in it. Okay, so this leveraged return is what we will calculate it by way of example again. So don't worry about that at all. So I'm going to jump on to my questionnaire on equity, and that's exactly the question from Tane will come into picture as well. So an investor purchased 200 shares of Suzlon on margin. Now, margin means using a loan facility. The shares are trading at 40 and the initial margin is 50. So you tell me how much money the investor would have put in. There are no brokerages, otherwise I would have put in some amount of brokerage as well. If the investor sells the stock when the price rises to 50, so the total return that he makes is 10, but by putting in just 20, so the return of the investor is 50%. If you look at the total return on the asset, by investing 40, the return of 10 is being made, which is 25%. An investor has been able to double his return on equity, because he's been able to create a leverage. This also brings me to the point of DuPont analysis. If you look at it, DuPont is net income upon sales into sales upon assets into assets upon equity. I'm going to club the two, and net income upon assets will become return on assets multiplied by the leverage ratio. So return on asset in this case, if you look at it, will become, like I said, 10 upon 40, 25%. So return on asset is 25% and the leverage ratio 40 upon 20 is 2 times. So your return on equity is almost double of the return on assets. So I've been able to connect the leverage return with what you have done in your FRA as DuPont. Okay, so let's just move forward with that and move down. I'm going to skip question number 2, which is pretty straightforward. How do you calculate, an annual return from different quarterly return? So, a quick answer to that is that you multiply all, but the error that you should not do is you're not required to calculate the average quarterly return. An annual return is not equal to average quarterly return. The difference between the two is in calculating the average quarterly return, you will have to do the geometric mean of all, whereas in calculating the average return, the simple thing that you're going to do is just have different factors being multiplied. You don't do 1 upon n minus 1 like that. Okay, so just multiply each factor and then multiply by 1 to get to this particular number. So if I have to do that quickly, 1.1 into 0.91 into 0.15 is giving me a loss overall of negative 1.001%. So that's not per quarter on an average, that is overall for the annum. Okay, so now coming to Tanay's question, the Jubilant's Food Works has just paid a dividend of 0.8. Okay, now Tanay had asked a question whether justified value calculation would come in the exam. Obviously, like I said, it is very, very important, and you are expected to get numericals like that as well. So with that, I am good to do question number 3 here fairly quickly. It says the Jubilant had paid dividend of 0.8, so this becomes my D0. Just paid is historical number. If it would have been is expected to pay, that would have become a futuristic number. Then it says analysts expect dividend to grow at 25% in the next 2 years. That means the growth, let me draw a quick number line, year 1, year 2, year 3, year 4, T1, T2, T3, T4, and let's say T5. So the growth percentages is 25, 25, then 15, 15, and then 8% thereafter. So here the quick point is, like I said at that time, the justified value is the present value of all future cash flows. So the future cash flows are D1, D2, D3, D4, D5 to infinity. What you now need to understand is that D5 to infinity will be calculated as P4, and I'm going to apply Gordon's growth model here. So P4 is a representative of all the dividends after time zone 4. Some people call it as terminal value. Terminal value is the value which is created at the terminal of the forecast horizon. Sorry, not at T5 but at T4. This 8% is a simplifying assumption because up to 4 years I can very well categorically specifically find out as to what is the growth, but after that my estimates become a little hazy, and therefore I have chosen to use 8% as a simplifying assumption. Now 4 years become my forecast horizon. After that is some of the simplifying assumptions I have to take, and The value at forecast horizon, the end of it is called as a terminal value. You can calculate it either by a multiple method or by a present value method, pretty much like a Gordon. So here I've done it by Gordon because the growth had become constant. Word of caution here, you cannot apply the constant growth model at T1, T2, T3 or T4 because in none of the years, first, second, third and fourth, is the growth constant. Okay, so what you have to effectively do is find out D1, D2, D3, D4 and P4 and then discount it respectively. So it's pretty straightforward. For example, 0.8 into 1.25, it's going to be $1. It's going to be $1.25. D3 is going to be 1.44. D4 again is 15% up, 1.65. And D5 is going to be 1.78, based on which cost of equity, we have to calculate by CAPM. Beta is 1.4 and the equity risk premium is 6. So 1.4 into 6 plus risk free. So it is 14 6 84 plus 4, 12.4. minus the growth was 8. So 1.78 divided by 4.4%, 40.5 is your P4. So so what you have to do is you have to just find out the present value of, let me just circle those, find the present value of 1, 1.25, 1.44, 1.65 and 40.5, which is nothing but your price 4. Just calculate the present value based upon the cost of equity which you have calculated to be 12.4. So what you have to carefully note is whether the initial dividend given is D0 or D1. If it is D1, then you don't have to calculate the growth for the first year. First point. The second point is calculate the cost of equity very carefully. Third point is plot the timeline for simplicity's sake. Sometimes students are too overconfident and they don't look at this particular aspect. They directly try and look at the cash flow. So it's always easy to go fundamentalistically. Okay. So coming to the next point here, on the market efficiency, not allowing the short selling will most likely increase or decrease the market efficiency. Well, short selling is one of the factors which help arbitrage make money and therefore restore the equilibrium. So in a way, it is one of the activities which, if stopped, will increase the market inefficiency. So therefore the market efficiency will get decreased. What you have to understand is whenever there is a situation of non-equilibrium, for example, the market price is 80 and the justified value is, let's say, 95. So gradually you will find this 80 becoming 95. Now how will this happen? This will happen by way of buying process. A lot of people will start buying it, and there will be a buy pressure, as a result of which the 80 will start becoming 95, and let's say the moment it becomes 95, the buying process is going to stop. So in a way, the arbitrage helps us to achieve equilibrium. Short selling is one of the tools of arbitrage. If not there, it's going to decrease the market efficiency. So decrease becomes the answer. Point number 4 here is that assume a stock index consists of many firms who have recently split their stock. There are 3 levels of indexes that you would recall. One is the price index, the other one is value index, and the third is the unweighted index. Whenever there is change in the market price, not the quantity but just the market price, is a price weighted index which has to be most frequently affected. So since the market value remains same, the moment you split the stock, the total market value remains same. In unbalanced, or should I say the equal weighted index, the third one, you also find a situation where the equal dollar amount is split. So in any case, I'm buying 10 share of 2 or I'm buying 5 share of 4. Overall, my $20 have been put in. So therefore, there is no need for rebalancing. The rebalancing situation in this case will arise only in case of price weighted index, where I select to choose only one particular share, in respectively of the market price. So the answer to that is the price basis index will be the one which will see a bias because of that listing of stock split. So with that, I am good to move to my next point here, which is the point of something called as ethics. I'm going to jump on to FRA towards the last because that's pretty lengthy a concept, and I have a couple of questions that I need to answer. Okay, fine. So this is like a question which is being asked by Tanay. It says that the equal weighted index does not need rebalancing. No, Tanay, that isn't the point. Equal weighted index needs the maximum rebalancing because of the fact that since the equal amount of money is being invested and different stocks move at different pace, so after every time zone you have to look at the stock which has grown up faster than the others. You have to sell that and invest some of the proceeds in the ones which have not grown so bad, so good. So but that wasn't the point. The point was which will see a bias because of that. Now the bias because of a stock split comes only in case of a price basis index, because there the selection methodology is the single unit price of every stock. So just to take an example for you, if Apple stock was 80, 1 MPS, out of 100, let's say out of 1,000 rupees, I have spent 80 in Apple. But the moment Apple stock becomes stock split 1 into 2, the market price becomes 40, price basis index is going to allocate only 40 to Apple, because the price basis index is, the psychology is, I'm going to pick 1 unit of whatever dollar value it comes at. I'm going to pick only 1 unit. Okay, so if that 1 unit is of 80, I'm going to devote 80 there. If the 1 unit is of 40, I'm going to devote 80. So the moment stock split happens, the relative weight of Apple goes down considerably. Okay, now Nitish has also asked a question: what is the difference between rebalancing and reconstitution? Well, let me use my Indian cricket team as an example for that. Now Yuvraj initially was playing at 6 down. Okay, because of certain situation he has been made to play at 2nd down. That's rebalancing. Rebalancing means adjusting the weights of existing securities, but you're not asking any security to go out or come in. But if let's say Yuvraj has been removed from the team and in his place some other security has been made to play, then it's called as reconstitution. Reconstitution means the face of the index changes, the constituents of the index changes. Not only the weights changes, but the new member comes into picture. Okay, so reconstitution is a relatively bigger issue compared to rebalancing. Okay, now I'm going to talk about the ethics. In a very, very fundamentalistic point of view, ethics has 15%. What you have to understand is this particular diagram. Okay, now I've drawn a tree here. Now you know it may become like a funny stock. Oh, sorry, I just removed that. 1 sec. Give me 1 sec. Let me choose a better color. Yeah. So I'm going to draw a tree here. Okay, and here are the roots of this particular tree. Here is the different leaves, and also this is the stem, the basic stem. Okay, and from stem there are certain branches that are coming out. What you have to understand is these roots are the codes. These thick trunk are the standards for professional conduct, and any one particular aspect which branches out, an example of that is GIPS. GIPS also stems out from standard for professional conduct, duties towards client, performance, presentation. That particular standard is detailed as a separate rule called as GIPS. So codes are like the basis of all the standards that come into picture. Codes are relatively subjective and relatively more holistic and comprehensive, whereas standards are a little more pointed and objective. There are 7 standards, 6 codes. Obviously, there's nothing great that I've told you on this, and any particular standard, when it kind of becomes a very specific, is made into a separate set of rules. For example, in level 2 you're going to talk about research objectivity standard. Now those are the standards which are applicable only when equity analyst comes out with a research report. Okay, so there used to be, till last year, there used to be a standard called soft dollars. Now soft dollars are also like GIPS, the branching out of it. The only thing is they had branched out from 3A, the loyalty towards the client. So soft dollar had an entirely specific rules, very important from exam standpoint. So the way I look at it, you do your codes is you have to memorize all the 6 codes, and not only that, you have to connect the codes with the standards as quickly as possible. What I'm trying to say here is, here as you look at it, this is pretty much a mother statement which talks about certain aspects of using the diligence, respect, and ethical manners with clients, prospective clients, so on and so forth. So the same word diligence is also there in standard number 5. So the codes that you see form part of the standards as a more pointed thing. Code number 3 here, it talks about the reasonable care, the independence, and the professional. So these are the key words which you will find repetitive in the standards as well. So read the option very, very carefully. Now I have a simple ground rule for anyone who is going to attempt ethics. I'm not going to look at the codes as such, nor I'm going to look at the standards. Standard are like pretty much the same stuff. What I would request all of you to kind of look at this particular aspect very, very carefully. There will be a case that will be given to you. Number 1, there will be a behavior pattern of different people in that case. What you have to very clearly come out with, you need to select the member or the candidate, because you know that the CFA Institute rules and regulations are applicable only on the members and the candidate. And on those behaviors, you need to pass a judgment. That judgment need to be passed like a judge, considering everything, all the aspects, put together. The good news for everyone is that the options would be given to you. So read the options very, very carefully. What I'm trying to say is, sometimes you might find there is a conflict. A particular case may create violations in more than one standard, in which case you first have to see that which is the most specific violation, if at all that happens. An example of that is, if you go to misrepresentation here, in particular, they talk about very, very specific aspects of the plagiarism and guaranteeing the future performance. Now, if a future performance has been guaranteed, not only it might also create a conflict between the communication with the client, which is standard number 5, it is a specific case under misrepresentation. Now in this case, the specific case under misrepresentation has to be violated under 1C. So you have to be very, very specific, in that sense. Okay. So my suggestion to you would be that you should memorize all the headings. So like, for example, if the question asks you 4C, then you got to, you should be able to understand what was 4C and, so on and so forth. So keeping that in mind, I would like to just pass on to GIPS, which is one of the branches that I had created, and it's like one single slide that you have to just look at it as a summary. Some of the quick points here is that GIPS has got 9 sections. All the 9 sections have to be ratified. You need to remember it. The way to remember it: FICC, DP, fundamental, input data, composite construction, calculation methodology, disclosures, presentations, and then you have real estate, private equity, and separately managed accounts. So these are the three sections which are there for three specific assets: real estate, private equity, and SMAs. Disclosure and presentation needs to be clubbed together. I'm just giving you how to remember it, and FICC is the way you want to ratify it. So the CFA Institute not only is particular about what is written in there, CFA Institute is also very particular about whether the student knows how many sections are there and which are the names of the section. So do you see that materiality is not a section here? CFA Institute might ask a question, which of the following is not one of the sections of GIPS? So materiality becomes the answer. So another point on GIPS is absolutely important that the entire firm follows with the standard, and not only that, if they decide, then all the provisions of GIPS have to be followed. Okay, composite is like the most important aspect here, and it's like the grouping of similar portfolios. What do you mean by similar portfolios? They have to be actual fee paying, they have to be discretionary, and they should have a similar investment strategy. Which portfolio is tagged into which particular composite? It should be done not should be done post facto, but it should be done pre facto, so that the biases can be removed. Okay, it is not mandatory but recommendatory to follow GIPS, and yeah, if some firm wants to get it verified, then yes, they can do that. The verifiability, the audit of it is also optional. Nothing very strict or mandatory about it. Okay, so with that, I am good to come to the last section here, which is the section on FRA. And that is really going to be the meat of the. So these are like the important topics in FRA that you have to kind of look at it. What is very, very critical to understand is again, like I said, that this list is not going to be very comprehensive, but that will be the list of confusing topics that a student might get confused in. So I'm going to start with one of the very, very basics about what is accrual and cash. This is a point where a lot of sciences face a lot of problem. What you have to understand is accrual means happening of something, and cash means the cash flow associated. So if, let's say, I'm just assuming that, let's say, this webinar would have costed you, for example, $40, and this would have continued for 2 hours. Okay. Now, in this case, if, let's say, you would have paid beforehand, then this would have been a case of cash preceding accrual. If you would have paid post facto, this would have been a case of accrual preceding the cash. You have been taught first, and then the cash flow has happened. These two give rise to some of the things like, if the cash is preceding accrual, then from a receiver point of view, it will give you a pre-received revenue, or also called as unearned revenue. From a payer standpoint, it gives them prepaid expense. If the accrual happens before the cash, then from a receiver, from the person who has taken the service, it becomes accrued expense, because he has accrued that expense first. And from the service giver point of view, it becomes accrued revenue, or pending revenue, or by whatever name called. Okay, if both happen together, then your P&L gets hit and your cash is effective. So there is no asset or any other liability that gets created. So what you have to understand in that FRA, we extensively use the concepts of A is equal to L plus C, and that's how we will get to know whether the accounting is complete. There are two broad exceptions to the accrual. One, where the accrual says that you should book your revenue only when the work is done. There are some exceptions to it. You can book your revenue before the work is done, and that's the case of long-term contract. Sometimes you are unable to book your revenue even after the work is done, and that's a case of installment sales, and that's where the uncertainty is high, and the payment is not certain. So that's where your accrual fails. So in each of these, there are two cases separately, and I have questions for that, so we will maybe talk about it through them. There's something called as diluted EPS, again very, very important aspect, and that is where the concept of a hypothetical and pessimistic scenario comes into picture. What I mean by that is there are certain potential equity which a company has already issued. If they get converted into equity tomorrow, they might pull down the EPS or they might increase the EPS. So I am interested in looking at this potential security which has the effect of pulling it down. These are called as dilutive potential securities, because my diluted EPS is a worst case scenario, it's a pessimistic scenario, so all the potential security which if turned equity tomorrow have the role of pulling it down, I'm going to look at them and calculate the diluted EPS. So here I'm going to draw a quick diagram. Maybe let me just clean the board a bit. I'm going to draw a diagram here. The equity can be actual, which is existing in actual equity form, or it can be potential. Okay, now potential security could be dilutive or it could be anti-dilutive. If let's say I have to put some numbers here, these are the number of shares. So the denominator for my basic EPS is going to be 20, and for my diluted EPS is going to be 20 plus. It's going to be 20 plus the dilutives of 5. So for diluted EPS, it's going to be that. So read the question very carefully. If the question says what is the addition in the denominator, then the answer is 5, and what is the total denominator, then the answer is 20 plus 5, 25. Okay, so we're going to talk about that through an example again. Let's talk about the different types of passive investment. A very, very common error that you will commit. These are like the part of the inter-corporate investments, can be divided into the active investments and the passive investments. What you always remember is that the passive investments could be held to maturity, available for sale, and trading. But you forget that there is another valuation model called as fair value model, which is available to value these passive investments. So each of them have different rules which I'm not getting into, but this is something that you would tend to forget. So please recall that fair value is also possible for passive security. Let me bring it a point that the fair value is also possible for, in addition to passive investments, it's also possible for investment property. It is also possible for your bond valuation. Okay, so keep that in mind. Point number 4 is very, very critical, conversion from indirect to the direct method of cash flows, and that's where you have to apply your basics. And I'm going to quickly take an example here based on that. Let's say sales during the year based on accrual has been 1,000, and your account receivable, the opening balance and the closing balance have been 40 and 45. Now, if someone asks me to calculate the cash collection from customer, so Vivek and Nitish, I'm going to take your questions in a while. Okay. Vivek has asked a couple of questions on EPS, and Nitish has asked questions on revenue recognition special cases. So that's exactly where the exception to accrual comes into picture. So Nitish, we're going to talk about it when we'll do the questions. So coming to this particular point of conversion from indirect to the direct method, you will recall that the direct method requires bank account of that particular company, and from that we will take out all the cash. But indirect method requires the income statement and the balance sheet. Can we somehow use the inputs of indirect and still give you the output of direct method? So let's say cash collection from customer is like a direct cash flow. Can I calculate that using these 3 figures? The answer is yes. If I have to logically think about it, 40 was due at the beginning of the year related to the last year. 1,000 has been the sales for this year. So if nothing would have been received, 1,040 would be the total due. But my balance sheet says it's only 45 which is due, which means that 995 would have been received during the year. For people who know how to make an account receivable, the ledger, the opening becomes 40 here, closing becomes 45 here, sales become 1,000 here. What is that X which will balance the two? So this is for commerces, but I never kind of follow this account methodology, because obviously FRA for a CFA course is not an accountant's degree, it is an analyst degree, so you have to keep that in mind. So this particular point of conversion needs to be done in a very, very important manner. Just a point in case that you have to write here, if you have to move from COGS to cash paid to suppliers, you will first have to calculate the purchases. Okay, and the purchase here, the relationship between these two is inventory and cash paid to suppliers, and the relationship between these two is accounts payable. Okay, so this is like the chain that you have to maintain all the time. From COGS directly, you can't jump onto the cash paid to supplier. For a question that, let me just take a quick question. Saurabh has asked a point where reconstitution stocks are added or deleted from the index. Now, Saurabh, to answer your question, reconstitution means if there are two stocks which have been removed, then two will have to be added back. The index has a number of securities which are fixed. So let's say BSE Sensex has got 30 securities. So it's like, the chairs on a dining table. If there are 30 chairs on a dining table, then at a time 30 people will dine together. If two have to go out, then the balance two will come in. Okay, to answer Vivek's question, in case of calculation of diluted EPS, when convertible preference shares and bonds are present, Vivek will do that by way of an example, but he's asking, is it necessary to calculate them individually and calculate them together? No, Vivek, the impact of dilution needs to be looked at individually. Whether a particular security, you'll recall the graph that we had made, the potential security have to be divided into dilutive and anti-dilutive. Okay, so this particular calculation needs to be done in a very, very individual manner. While I'm looking at a particular potential security, I will keep everything else constant. So ceteris paribus is like the rule of the game. Okay, and finally, while calculating DEPS, all dilutives are going to come here together. Okay, so the impact assessment happens individually, but the final formula, the final calculation happens together. Okay, so moving at the DuPont. DuPont is basically an extension, like I said, while doing, the equity. So net income upon sales, sales upon asset, and asset upon equity. Not only it is important to raise the money from the cheapest possible source, which is debt. If the debt is high, then this ratio is going to be high. It is also important to put that money into an asset which gives you the maximum sales. But only generating sales is not critical. What is also critical is to generate sales which gives you the maximum profit. So if you look at it, the entire return on equity has been broken down into three very, very critical ingredients. First, the borrowing aspect about the firm. Greater the debt, the better it is. Then the operational aspect about the firm. And the last is the the profitability aspect of the firm. Okay, so that is something that is extremely, extremely critical, from an understanding standpoint. What is one of the most interesting aspect is the LIFO reserve, and LIFO reserve is nothing but hidden profit, which has been hidden by understating the inventory. This is the profit, or this is the delta by which the LIFO firm will underreport its inventory. If you look at it, the underreporting in inventory will translate into underreporting of profit. Okay, the question is, would the LIFO firm ever show this profit which they are hiding? Answer is yes. When this particular inventory will finally be sold, the LIFO reserve will get unleashed. So if I look at it, the total profit shown over the lifetime of the firm is same for a LIFO firm as well for a FIFO firm. The only difference is that a LIFO firm pays the taxes later because they postpone the taxes. Therefore, the same dollar amount of tax, if paid at a later point in time, gives you a greater present value of the the firm today. So in a way, I can say that from a valuation standpoint, absolutely ceteris paribus, if everything else is same, LIFO's valuation is more because the tax payment are being made at a later point in time. And why does that happen? Because they are understating the profits initially, and they will unleash that when this inventory will get sold. Okay, so like pretty interesting concept. So let's see if we find time, so we will be able to look at it by way of question as well. Let's move to the part here, which says the accrual versus cash principle of accounting is what we have already covered. The impairment and its different aspects, very, very critical. What you need to understand is that there are first of all two types of asset. The assets which are held for use. Okay, now in FRA, the 20% of the course, you need to learn the standards of US GAAP as well as for IFRS. The rules here are a little different. Let's talk about the US GAAP first. You first need to check the recoverability test. So there, the net book value needs to be compared with the undiscounted cash flows. If the net book value is found to be more, then as a second step, you got to look at the actual impairment loss calculation, which is net book value to be compared with the fair market value. Okay, under IFRS, the fair market value is compared with the the discounted cash flows. The higher of the two gets to be compared with the net book value to be able to give you that impairment loss. So IFRS is a little different than US GAAP. IFRS says the impairment loss reversal is also allowed. US GAAP says no reversal is allowed. But for another type of asset which is held for sale, now understand this point, that this is a long-term asset which is not being purchased for the purpose of sale. It was initially being purchased for use, but later upon, when the new asset has been replaced, the old asset has been replaced by the new asset, then this particular intention becomes held for sale. Let me give you an example. I was holding a particular TV, like a box TV. Okay, the moment I purchase an LED, the way I used to look at this fixed asset changes. Earlier, I used to hold this box TV for use, but now I'm just holding it for sale. I've put that on OLX, and if I get a good buyer, I'm going to sell it. So till the time it is with me, lying in my storeroom, I will recognize it as held for sale. Now this is a condition wherein the impairment loss reversal is allowed under US GAAP also. So this is one of the exceptions where US GAAP also allows the reversal for the impairment loss. Okay, very, very interesting and critical aspect. What is all the more critical is point number 9, and herein where the question of different models being used comes into picture. My US GAAP is very clear that they follow only the historical cost model, where the capitalization happens, depreciation happens, sometimes impairment happens. Okay, and no impairment reversal is allowed. My IFRS talks about two different assets. I want you to draw this diagram with me. One is the normal business asset, for which my IFRS has got two models, historical cost model and the revaluation model. Historical cost model is absolutely similar to US GAAP, except the fact that the reversal of impairment is also allowed. Under revaluation model, the fair value is being used for the purpose of balance sheet, and the delta between the last fair value goes to the P&L or OCI, depending on whether it is above the historical cost or below the historical cost. However, if it's an asset which is an investment property, this concept exists only in IFRS, then we can follow a fair value model, wherein the balance sheet value still happens at fair value and all the deltas go to the P&L. All the delta go to the P&L. Okay, so I have a quick question on that, which we will do it in a jiffy. So just look at that, these models. What is critical also is to understand that a sale type lease is an example of finance lease, wherein the lessor not only gets the financing income, also gets a gross profit, which is the profit at T0 for manufacturing and selling the particular asset. So honestly, from a lessee standpoint, he is not affected whether the lease is a pure finance lease or a sale type lease. So if I have to bifurcate that, lease can be financial and operational, and a finance lease can be a direct finance lease or a sale type lease. From a lesser standpoint, both mean the same. Okay, but for a from a lessee point of view, both mean the same, but for a lesser point of view, the two are different. Okay. Point number 11 is again very critical, which talks about the amortized bond value. It is the present value of future cash flows discounted at original YTM, which is nothing but the market rate prevailing at T0. If I have to calculate the market value, my cash flows remain same. It's just that the discount rate, rather than being of T0, becomes of the point of calculation. Okay, so that's like the two differences. Very critical and important aspect here. And the last study session, like I said, is like the C category, but you got to still look at it. This is the important concept of fraud triangle, which says that as to why the fraud happens. So there are three broad reasons about fraud being happening. One is the possibility of fraud. The opportunity is there. Second, there are pressure on the management. And third, is the incentive. Not the incentive. Incentive was part of the management. It is the human behavior. To err is human. There has been some incentive, and the fraud was possible. You would not hear about fraud in Swiss bank, because there is no possibility of it. The security systems are such. Okay, so pretty much like that. So with that, I'm going to look at the question sheet of my FRA, and I'm going to quickly cover a couple of questions only because the time is almost like elapsing. What I would also do is give you my email ID. Should you have any problem, it is ankur_srcc@yahoo.com. You can also note down the number here, which you can use up to your exam or maybe after that, for any doubt that you may have. You may give me a call, or maybe WhatsApp is like the better means. So just make a note of that, because I think that we'll not be able to cover all the questions of FRA, which I would like to. So maybe I will email the attachment to you. Can I use it as a handout? Give me a sec. Handout. Okay, so maybe I'm unable to give that to you as a handout, but anyhow, so I would email it to you separately. So with that, I'm good to start with my question on FRA, and here it is. Okay, so let me just add a pen. Some of the important points that I would like to highlight here. So give me like 10-15 minutes more. So I know we are shooting the time, but I think this is extremely critical. It encompasses 20%. This is 1 by 5 of your total effort. So here the first question is the difference between the qualified and the adverse report. There are 4 types of report: a standard report, a qualified report, an adverse report, and disclaimer. So qualified report is one where there is an error, but the error is not material enough. Adverse report is one where there is an error and the materiality of error is also there. So the similarity between the two is, in both the cases there is an error. The only difference is, in a qualified report the error isn't material, whereas in case of an adverse report the error is material as well. Okay, so my question number 2 is on the special cases of revenue recognition, wherein this is like a long-term contract, and you would recall that it had got percentage of completion method as well as the completed contract method. Now under percentage of completion method, I will book revenue according to the degree of completion multiplied by the total revenue, and degree of completion I can calculate according to the work done. So if the total cost to be incurred is 15 million over a period of 3 years, 20 becomes the total revenue. How much is the cost that I have done in second year? It is 5. So 1 by 3 into 20, 6.67 is the answer. Okay, if this would have been completed contract, then under the US GAAP says that you should book 0 revenue except in the last year. But my IFRS used to say that the revenue should be booked equal to the cost. So if this same question I would have to do as per IFRS, and I will book my revenue equal to the cost being written here. So as in the exam, you have to be very, very clear and cautious about the fact that is the question asking about the revenue part of it, which in this case is the case, or is it asking about the profit? Because as per US GAAP and IFRS, the profit calculation is same, but the revenue calculation is different. Another important point that I would like to highlight is if the question is silent, then I will always follow IFRS. I will always follow IFRS. Okay, so keep that in mind, while you're doing the questions for FRA. Okay, so I'm going to jump on to diluted EPS, and I have to read the question, and this is the case of partly paid up options. You would recall that the options can be free of cost, and the options can be the partly paid up as well. Now if the options are partly paid up, which is the case in this particular context, then here you have to calculate the dilutive security wala portion alag se. So the way you got to do that is by the treasury stock method, the total options 1039 need to be bifurcated into fully free and fully paid up, and this is what I have to consider for my calculation. So fully free portion I can calculate either directly by looking at the discount that I am giving. The discount that I am giving is on the value of 16, I am charging 11, so there is a discount of 5 over 16 on the total number of 1039, which is 325. So directly I can get to the fully free portion, or by using the treasury stock method, I can also calculate that by saying if every option is exercised, so I'm going to get this much money, and using this much money, if I am able to get access to my shares at 16, because that's the average market price, into 11 divided by 16, so that would mean that the money that I've got will suffice only for 714 shares. But in total, I am issuing 1039. That means 325 shares have been issued for free. So this is the portion of dilutive security. This is the delta that I need to add. The shares to be added, the answer is 325. 90% of the students would write 714 because the calculation that they would do by the treasury stock method will give them this number 714. But they have to understand that this is just the calculation of the fully paid up. So you have to be very, very strong on the fundamental in that sense. My question number 5 is on the different types of securities. You would recall HTM, AFS, and trading. And I'm going to, in this case, take example of available for sale because that's the most complicated and most probable to be asked in the exam. It says that a share of 80 has been purchased and the market value of that becomes 95 by the end of the first year. And it was finally sold for 83. So what are the different accounting treatment for the first year and the second year? Here, the $15 of unrealized gain will be parked in OCI, and later upon when it will be sold, the OCI will be reversed and a net gain of 3 will be parked in P&L. The rule is that the realized gain should always go to the P&L. A is equal to L plus C. If I have to do in the second year, let me just write that down again. My assets, which will be worth 95, will go down. Cash will come up to the extent of 83. So overall, the assets go down by 12. My OCI, which was a temporary parking of the figure, is going to be here going down by this is a gain, so it will be reversed, so it will be down, and there is a gain of realized gain of 3 that will be parked. So overall this also is down by 12. So this is like will happen in the second year. Okay, I would request you to do these examples in detail, read out the different provisions. This $15 of unrealized gain will not be recognized at all in HTM, will be recognized in P&L and the trading, and will be recognized in OCI in case of AFS. What is very, very critical from an exam point of view is question number 6, which talks about the difference in IFRS and US GAAP as far as the tax treatment is concerned. Here is an asset whose book value is 40,000 and which has been sold for 48. The tax rate applicable on capital gain is 20%. So on the date of sale, how would you report different cash flows under US GAAP or IFRS? So let me make a table for that. And these are like the common error points which are sometimes created. This is US GAAP and this is IFRS. This is CFO and this is CFI. Now for the sake of simplicity, I have to draw that again. US, IFRS, CFO and CFI. I have not chosen to write CFF because obviously everyone knows that CFF has got no role to play here. So if I look at it, on the date of sale, 48,000 is being, let me draw on the other side, US GAAP and IFRS. Sometimes, yeah, CFO and CFI. Now, an asset has been sold for 48, so both under US GAAP and under IFRS, an inflow of 48 shall be recorded. The difference between the two, between the US GAAP and IFRS, is on the tax treatment of it. So there is an 8,000 of gain on which 20%, which means 1,600 rupees, $1,600 is to be paid to the government. The question is, where would you show this $1.6 to be? So my IFRS says if you can relate that to a particular activity, show that respectively, but my US GAAP says tax on any type of income is to be shown under operating. So the similarity between US GAAP and IFRS is that the basic transaction gets to be shown under the same head, but the difference between the two is the tax treatment of it. So read the question very, very carefully. It is going to be like a confusion that will be drawn for you. You should not fall into that trap. Okay. The 7th question again is like pretty much repetitive of the confusion that I was talking about between the interest paid and received under the US GAAP and IFRS. US GAAP says everything, interest paid, interest received, dividend received, everything is operating except dividend paid. So it is the dividend paid which is under financing, rest all the things are operating. Whereas my IFRS is very logical. It says anything that you pay must be on the capital structure, therefore it should be financing. Anything that you receive must be on your investments, therefore should be investing. What my IFRS generally does is he doesn't make it mandatory to it. It says, or you can classify it under operating as well. Now the fallout of that is if there is a choice under IFRS, then the likelihood of a question being asked is relatively lower. Okay, because you can't have a scenario where two answers are correct. So with that, let's just quickly move on and select one more question that we can take, and that's the case of LIFO reserve, maybe that I can take up. And in this case, the first purchase was of 30, the second purchase of 35, and the third purchase of 37. What you have to understand is that as per FIFO and as per LIFO. As per FIFO, it will be 30, closing stock is 35, which will become the opening for the next year. It will be 35, and 37 is the understatement. The sale of the stock as per LIFO will be last in first out. The unit of 30 remains with me. 37 again goes out, and unit of 30 again remains with me. So here I'm starting at T0, at T1 and T2. What you have to now understand is, at the beginning of the first year, there was hardly anything to hide. So the profits LIFO reserve, like I said, was the profit that have been hidden. In the first year, the COGS of a LIFO firm is higher by 5. So these are the amount of profit that a LIFO firm is being able to hide. The question is where? By understating its inventory. So the total LIFO reserve by the end of the first year is 5. That tells us that a LIFO firm has hidden profits of 5, which may get unleashed tomorrow. In the second year, if you look at it, again, there is a delta of 2. That means in the second year, $2 have been hidden, and therefore the total profit that is being hidden is plus 5 plus 2 is 7. Okay, so LIFO reserve, if I have been given the value of LIFO reserve, I can quickly, calculate the difference in the inventory, or if I have been given the delta LIFO reserve, then I can quickly jump on to the COGS. Okay, there was a question here which talked about, how is LIFO reserve a hidden profit? Now imagine if in the third year the unit is sold for 38, then a FIFO firm is going to show a profit of 1, whereas the LIFO firm is going to show a profit of full 8. So that means the LIFO firm will show a greater profit of 7, which has been hidden so far. So this just makes that point that I was saying, that over a lifetime, the total profit that will be made will remain same. It's just that LIFO will pay, taxes a little later. So therefore, there the advantage of, the valuation comes into picture. Okay, so maybe the last question that I'm taking for today is the question number 10, and for that I will have to create a little bit of drawing which says that 0.3 was the historical cost. Last month the market value fell down to 0.25, and after which the market value again rose back to 0.40. So what are the different balance sheet values as per the different valuation models? Now you have to recall it very, very sharply, saying that under US GAAP there is only one particular standard, which is the historical cost. So as per the US GAAP, month 1, month 2, I will record an impairment of 0.05, and in the second month, when the value again has gone up, the impairment loss is not allowed to be reversed. So therefore the balance sheet value will still remain to be 0.25. So you would recall that under historical cost, as per US GAAP, the reversal of impairment is not allowed. However, if I have to look at the IFRS historical cost model itself, then impairment is obviously allowed, and the reversal of impairment is also allowed. So from 0.25, I will book my asset at 0.3. That means whatever loss I have incurred, I will reverse that in the second month. But sure, as you've been able to clearly make that out, that I will still, under IFRS as well, the historical cost model, I will not be able to raise it above the original historical price. Under revaluation model, let me draw out a line and call this historical cost. So anything goes above this is part of OCI, and anything which is below this is part of P&L. What I'm trying to say is, as per the revaluation model, the valuation always happens at fair price. So at the month end, it is going to happen as 0.25, and in the second month, it's going to happen at 0.4. The impact on to P&L and OCI is going to be like that. If from 0.3 it goes down to 0.25, there is fall in the P&L because this movement is below the line, below this historical cost, so therefore your P&L will be affected. Nothing goes into the OCI. But in the second month, when the value goes up overall by 0.15, then from 0.15 up to 0.3, it is the below the line item, it is going to still impact your P&L. And anything above that is going to impact your OCI. So that's how your revaluation model works. If I have to follow the investment property model, now in that case, this also gets converted into P&L. Anything above or below is going to be part of your P&L structure. So that's pretty much it. So maybe that brings me towards the end of today's session. It's been absolutely wonderful and encouraging session for me, at least. I would hope that you had a great time. Fin Study Club has partnered with Edureka to kind of give you that experience of professional people teaching you in the best possible manner. So so maybe so you can log on to Fin Study Club onto the YouTube channel. There are a lot of videos which are available for free on similar typical aspects that you can kind of quickly refer through. We'll be posting a lot of new stuff here as well in the next 10 days for the help of the students. So look out for this particular channel onto the YouTube. The recordings of these will be available with the company Edureka, and they'll be more than happy to help you. So with that, I'm more than glad that this session almost like continued for almost 3 hours. Yeah, so that's exactly what is the question that had asked by Sunny, that do we have videos on each of these topics? So the answer to that is yes. So you got to go on to YouTube and type in Fin Study Club. So you're going to find a lot of videos there, Sunny. So a quick question on by Nitish. It says, what is the difference between periodic and perpetual? Well, in perpetual, Nitish, you got to really look at the calculation of COGS there and then. Whereas in case of periodic, you can wait till the end of the the period for doing that. So in LIFO, the results are different. So maybe the same video, Nitish, you're going to find onto our YouTube channel. So so due to paucity of time, it's always a better evil to be. There are two evils that you can get in a particular webinar. One, the time falls shorter, and the other, when there is like a huge amount of time which the speaker is not able to know how to pass it. So both are wrong, but yeah, I mean the better evil is that the time falls short, because that tells us that there have been great interest, and I really thank you for that. And I hope that you do your level 1 with flying colors, and we meet very soon in level 2. I wish you all the very best, from Fin Study Club, the training part of it, and I wish you the best. And with that, I'm absolutely good to end this webinar. If just a quick point here, the session tomorrow also starts at 8. The session will be conducted by Amit Parekh. Amit Parekh, like I mentioned, has been a seasoned CFA faculty. Not only that, he takes up classes for different courses like CA, and also so pretty robust as far as the fundamentals etc. is concerned, pretty sought after faculty at different MBA schools as well. So I mean, he's a CA, he's a CS, he's a CFA, he's an FRM, he's an MBA. So, whatever you want to be, there's a likelihood that he would have that degree. So, it's a great colleague to work with, and he's a lovely partner there. So between Amit and me, we bring together a good combination where I take up FRA, CorpFin, equity and ethics, and he takes up the balance application oriented topics. So that's like a good combo that we bring to. So tomorrow's session also starts at 8 p.m. and that's also expected to go to 10:30, depending upon the questions etc. that he has to do. So with that, if there are no more questions, we are absolutely good to end. You can also, yeah, Sunny is asking for some mock papers. So Sunny, maybe rather than the mock papers, it will be better, just I'll send you some questions to practice. Because mock exams, it's always better to follow what CFA the institute has to say. Okay, as a student also I had believed it, and as a faculty also. So Karan is asking about the link about tomorrow. So I think 99.99% the link would work for tomorrow as well, but I will have that checked with edureka. So just give me one sec, let me just check that. Students are asking, will the link be same as today? I think there is an email that you would be given, so maybe you guys can check. I think 99.9% it is going to be it is going to be same. Let me just see if the IT guys can reply on that. If no, then maybe you can use the same link, or I will if you would have provided them the email ID, which I think you would have while logging in, I will ask them to share the relevant link with you tomorrow afternoon. Okay, so another question from Karan is, would the CFA mock practice questions suffice to practice before the exam? Karan, it's a matter of effort that you want to put in. What I'm trying to say is no number of questions will suffice for the exam. There is no limit to it. It depends upon how much time do you have. As a faculty, I never have requested anyone to look at the questions before doing the concept. It is always important to look at the question, to the concept first, and then maybe look at, so the concept and the strength has to be there. There's no point in having a mock exam with 40% result. At least you got to try and score 70% here, so that in the exam you are able to get to 65. Okay, so that's like a point here. So I think Kalim Akhtar would like to ask something. Kalim, can you go on? Okay, maybe the microphone is an issue. So maybe Kalim, if you have a keyboard to your access, then you can just write down your query. Otherwise, you can ask the question on email or the phone that I had given you. So for the benefit of all, I'm just reiterating the number 9711066000 and the email ID srcc@yahoo.com. Okay, feel absolutely free to contact, and FinStudy Club will be more than happy to help you. So with that, I think you're almost touching 11, and it's been absolutely fantastic session. So okay, guys, thank you. Have a good night, good sleep. Please sleep at least 8 hours before the exam, and I will have Amit take up a 15 minutes on the exam strategy as well tomorrow. Okay, so with that, I'm absolutely good to go, and wish you all the best, and obviously look forward to speak to you on certain doubts and problems that you have. Okay, so take care, all the best. So everyone can just log off, and I will just exit the webinar here. Okay, so okay guys, good night, take care, bye.